Morning. I got some frost to deal with this morning. Letting the truck heat up. Wanted to talk about running numbers on a house that you got for no money down, 0% down or whatever. The ROI on them, it looks awesome. It looks great when you think about it, because you ain't got no money in it, maybe a part of the closing cost or something like that. So the return on investment is just awesome. You can't beat it. The cash flow, however, doesn't look near as good on a house that you bought with no money down as it does with a house that you put 20% down. I mean, you can look at the exact same house. You find your house that's in your price range on Realtor or whatever. You think I'd be a spokesman for a Realtor, but whatever. So you find your house on MLS, multi-listing service, and you run the numbers on that house with a 20% down payment, and then you run the numbers on it with no money down. And the cash flow looks way better when you run the numbers with a 20% down. It's because your mortgage is cheaper. Because the mortgage isn't as high. I mean, let's say a $60,000 house, you paid $15,000 down. The mortgage is only a $45,000 mortgage. So if you want no money down, it's $60,000 mortgage. If it's the same length of time, 20, 30 years, whatever. I do 20 years because that's what my bank lets me do. It won't let me do a 30-year, so whatever. But anyway, the numbers look better on that 20% down. Now, I read a book yesterday. I'm drawing a blank on what the name of it was. It was written by Robert Irwin and Robert Kiyosaki. Something like How to Invest in Real Estate or something. I'm not sure. But anyway, it was a new thought process to me. I had never heard this before. They said when you're buying a house, as long as the rent covers vacancies, well, it's not exactly, this isn't verbatim by far, but it's what I got out of it. As long as it covers vacancies, maintenance, repairs, mortgage, taxes, and insurance, as long as it covers all of that, then you're getting a free house out of the deal. So that's kind of, I was a little upset on the no money down houses because it wasn't cash flowing well. And after hearing that and thinking about it like that, it makes a lot more sense. And I still cash flow decent on my no money down houses. I don't cash flow great on them, but I do make a little cash flow. And you figure if that's covering the cost of anything, any repairs that needs to be done, any maintenance that needs to be done, and you're doing that principal pay down, then the house is coming along. You might, even if you're not making any money, you're just covering costs. So you're sitting along this flat line, right? Rents will increase over time. The internet says that typically they increase 3 to 5% a year. So you hold out for 4 or 5 years and you start making you a little cash flow off of it, and the whole time you've been knocking that principal down on the house. So let's say 5 years goes by, your mortgage has then got 5 years knocked off the end of it, and the rent's increased. So I mean, it's like, well, you might be starting over in 5 years. It might be like you're starting back at the beginning, but you're already moved that far along on the mortgage, and you have that equity, and it's all kinds of little advantages that I'd never thought about until yesterday. But anyway, I just wanted to share that. Like, subscribe, and share. I'll be talking to you soon.